Stop what you're doing, because the next shock isn't coming from a flashy headline or a viral clip, it's coming from the most boring place on earth, government bonds. And if that sounds ridiculous, good, because that's exactly why most people won't see it until it hits them in the face. We're watching a quiet dead squeeze build underneath the global system, and the warning lights are blinking in the one market that usually moves like a sleepy glacier, long-term sovereign debt. And when that market starts moving fast, it's not just a chart, it's the plumbing shaking. Today, I want to connect the dots between a bond sell-off that started making noise in Japan, the way that stress can spread across the US, the UK, Canada, and beyond, and why gold and silver are reacting like they can smell the next phase of this cycle before the crowd catches up. And here's what most headlines missed. Gold and silver have been printing record after record lately, and the moves are not random. Yes, we'll get pullbacks. Yes, the market will try to scare you out with sudden dips, but when metals keep climbing while bond markets are getting jumpy, that's usually the system telling you something important. Here's the part that should make you lean forward. Bond markets don't get emotional the way social media does. They reprice. They reprice because they have to, and when they reprice, they change the cost of money for everyone. So why did this flare up in Japan? In plain English, investors looked at election season promises, looked at the debt math, and started demanding a higher price to lend long-term. That's it. Not ideology, not drama, just price. There was a broad sell-off in longer-dated Japanese government bonds. Yields climbed, and the market's message was not subtle. We're not convinced the future is being funded responsibly. Now, I know what you're thinking. Japan is always in debt, so who cares? Okay, here's why you should care. Japan isn't a small corner of the market, it's a major pillar. It's a major source of cross-border flows, and it sits at the center of strategies that were built on the assumption that Japanese rates would stay low forever. And if that assumption breaks, the dominoes don't fall politely. We saw moves in the long end that had traders waking up fast. In the US 30-year, yields pushed up toward the high fours at points, and even if they settled lower later, the direction matters. The UK and Canada saw their own increases too. The numbers don't have to match for the message to be the same. Global duration is being repriced. Here's where it gets spicy. A large share of Japanese debt is held domestically by big institutions. Normally, that's stability, but stability flips into instability when those institutions decide long-duration bonds are no longer worth the risk. Because long-duration bonds are sensitive, a small move in yield creates a big move in price. That's duration, and duration is the silent destroyer in portfolios that were built for a low-rate world. One of the warning flares was weak demand in longer maturity Japanese bond auctions, and auctions are the place where the market tells a government the price of its promises. If auctions get soft, the government doesn't get to argue, the market sets the terms. Now, a bond sell-off in Japan can leak into the rest of the world through multiple pipes, and if you understand those pipes, you understand why gold and silver are acting the way they are. There are three big channels of contagion. Channel 1 is the carry trade. For years, borrowing in low-yield yen and investing in higher-yield assets abroad was an easy trade to justify. But if yields in Japan rise, that trade becomes less attractive. As the math changes, positions unwind, and unwinds force selling in other markets. That's how a local move turns into global pressure. Channel 2 is Japanese institutional demand for foreign bonds. If domestic yields rise, Japanese investors don't need to reach across the ocean for yield as much. That can reduce demand for US Treasuries, UK gilts, Canadian bonds, and other sovereign debt. Less demand means higher yields. It's not personal, it's supply and demand. Channel 3 is global balance sheet capacity. Investors have limited room to absorb endless debt issuance. If one country expands issuance, it can crowd out buyers elsewhere. If multiple countries expand at the same time, term premiums can reprice everywhere. Let me ask you straight, do you think governments can keep expanding borrowing forever without markets eventually charging them more? Yes or no? Pick a side and answer in the comments. Now, add geopolitics to this. Risk is already elevated. Investors aren't just thinking about inflation and growth, they're thinking about stability, sanctions, supply chains, and conflict risk. When stability gets questioned, investors demand a bigger cushion. In bonds, that cushion is yield. And here's a truth people hate hearing. Currency works because belief works. It works because people believe the issuer will behave. When belief wobbles, markets charge for uncertainty. This isn't about the end of money, it's about the price of money. And the price of money drives everything from mortgages to stock valuations to the cost of running a business. Now we get to the part that should make you sit up. Japan is one of the biggest foreign holders of U.S. debt. We're talking over $1 trillion in broad estimates. If Japan needs to defend its own markets or stabilize its currency, it can sell foreign assets. If a big holder sells, yields can rise quickly. And rising yields don't just hurt bond investors. They hit housing, they hit corporate refinancing, they hit government budgets, they hit the everything bubble that was built on low discount rates. So what happens next? This is where the story becomes choose your own adventure, and both paths can end up bullish for metals, but the timing can look very different. Path 1, yields rise, central banks hesitate, and financial conditions tighten. That can look deflationary at first. Risk assets wobble, liquidity tightens, and the dollar can strengthen short term because global investors run to the deepest pool. In that scenario, gold and silver can be volatile, even pull back, but they don't lose the fundamental case because tighter conditions eventually force a response. Path 2, yields rise, central banks panic, and the response is to cap yields with balance sheet expansion, liquidity facilities, or quiet backstops. That accelerates currency debasement, and that's when metals tend to catch fire. So when you see a new narrative pop up saying this bond move means metals are topped, or this is the last gasp, pause. Ask yourself, did the debt problem get solved overnight? Did governments suddenly become disciplined? Did deficits vanish? Or did the story just fit a headline? Because metals don't need permission from the news cycle to reprice. Metals reprice when trust reprices. Let's talk about why gold and silver have been acting like they know something. Gold is not a stock. It doesn't have earnings. It's a barometer. It measures confidence in money and confidence in policy. When the bond market starts demanding higher compensation for lending, gold hears that signal. Silver is more chaotic. Silver is monetary, but it's also industrial. It can whipsaw you. It can look like it's dying and then explode. But when silver starts moving in a macro-driven environment, it often moves like it has somewhere to be. This is why I keep saying if you're holding metals, your enemy is not volatility, your enemy is panic. Now let me give you what term premium actually means without jargon. When you lend money for a long time, you're taking more uncertainty. Inflation could rise, politics could change, a crisis could hit, so you demand extra interest as a cushion. That extra interest is the term premium. If investors suddenly believe the future is riskier, the cushion they demand rises. That pushes long-term yields up even if nothing else changes. And when long-term yields go up, the cost of capital goes up. That's when everything starts to feel expensive. So the bond market is essentially asking, do we trust the long-term plan? And right now, the market is asking that question louder. And that's the key signal that most people are completely missing right now.